Good day, fellow investors. We recently discussed how, in my opinion, this is a financial bubble, and then I discussed how value investing is better because it works no matter the market. However, there is some misunderstanding. It doesn't mean that value investing stocks or value stocks will not crash. It just means a different strategy when it comes to investing. Because everything crashes in a crash. That is something that's given depending on how people vote. If it is the end of the world, then everyone will sell, and that usually happens here and there. However, we cannot predict a crash, but we can own value. And that's something very different when it comes to long-term investing. Another thing, if you don't want to see your portfolio going down, then you have to be hedged, and we'll also discuss that, and then you can see what best fits you. Because if I look at the S&P 500, if I look at the P ratio 30, if it goes just to historical normal, that's 50% down. If the dividend goes to historical normal, that's 75% down, but maybe now the historical normal will be 3%. And you can see here that that happened 2007, 2009. 50% crashes are not something that we can avoid. However, if we look at value stocks, also in 2007, 2009, crashing 57%. Of course, that was from an exuberant position, and that exuberant position has been here for ADM, for example. Now this is already 50% down, so it already crashed. Can it go another 50% down? Well, yes, but if it goes another 50% down, this would be an 8% dividend yield. 8%. Can it happen? Yes, it can happen. It has happened in the past. But if the S&P 500 crashes 50%, this becomes what, 2.5 or 2.3 depending on the recession and everything, dividend yield, perhaps 2%. So when it comes to these numbers, which is better, 8% or 2% when it comes to crashes? And that's the difference between value investing and everything else. I don't need my stock to recover. I make money from owning businesses. And let's say that we go to 2030 and that this dividend keeps on growing, perhaps goes to 5%. Then if we look at the numbers and we reinvest those dividends, if we look at ADM, reinvesting dividends at 8%, you would still, after 10 years, be a very positive return. You would have double. If then the dividend yield goes to 5 or 4% again, this 2x becomes a 4x. This is what I'm saying is value investing, not anything else. And even if you reinvest the S&P 500, you are still, all else equal, 1.25% up, 25% up over 10 years. So this is the difference between value and everything else. You are being rewarded no matter the price. Temporarily, anything can happen. Value stocks can crash depending on the market sentiment, but long-term, the driver of returns is the value created by the businesses. If you can buy those businesses already at a lower price, that's already something. If we dig deeper, in the 70s, that was a bad time for stocks after the Nifty 50 bubble. Growth stocks returned 4%, value stocks returned 12%, and that because the P ratio was 10, dividend yields were high, and that is how stocks return. If we look at the lowest P ratio from, I think, 72 to 82, those stocks 10x'd over that decade because people were looking at value, at real rewards, when stocks stop just going up for no reason. So just fundamentals, that's what I'm discussing, nothing more. That is the driver of your returns. And you say, okay, but stock will rebound. Yes, if the Fed can print money into eternity, if deficits can go higher and higher. So anything can happen. But value investing is about focusing and having the mindset of buying more, owning more, building wealth through owning more of the same asset. And the crash is always better for value investments because we can buy more, reinvest the dividend, and over the long term, if you already like what you own, it increases your long-term returns. But then there is always the question of portfolio protection. Can I protect my portfolio? From a value perspective, you can then own more if you don't care about prices. But if you care about prices, first let me show you this. Berkshire Hathaway, 48% down in 1974, 31% down in 2008. So every 12 years from top peak to bottom, Berkshire has fell on average 50%. That's a given. So the focus is on earnings. If you can't lose, own bonds or be hedged if you can see your portfolio go lower. If we look at the options situation here, if you want to buy a 1-year put on the S&P 500, it's still extremely cheap, 4.6% of your portfolio, and you are hedged. So if the market crashes 50%, you sell that put and you are at zero. If the market goes up 20%, you will be up only 15, but it is something very interesting to consider. So the key is to know what you own, what is the risk, how it would affect you, and then adjust accordingly. I own very nice businesses. If there is a market crash, I could make more money on the volatility because that's what the businesses do. If there isn't, the businesses will just keep on growing, delivering their earnings over time, and that's about it. If the stock price goes lower, which every my position I know that I can wake up tomorrow and my portfolio can be down 25-30%. What do? Reinvest the dividends, the companies do buybacks, everything great. It's a long-term game, but I feel a lot of people have a short-term focus, and that is then what leads to panic, doing wrong, and things like that. Everything can crash, we cannot predict prices, we can focus on knowing what we own.